We're having a few technical difficulties. The lavalier mic seems to be feeding back, but we do need to get started. I'm David Bryce. I'm excited to be here in this session with you today. And we'll just do some brief introductions. I know you have the bios in the program. I'm a professor of strategy at BYU, and I've been at BYU for about 16 years. And I do research in corporate strategy and issues of growth. And so I'm excited to be here on a growth-oriented presentation and talk a little bit about some of the things that we're doing at BYU around the research and growth. And then I also have with me today Steve Daly and Matt Eyring. And Steve Daly is the CEO of Ivanti, which is a recently formed, or I guess rebranded, company that has been growing very rapidly through acquisitions over the last several years, and he'll be talking about some of his experience with acquisition-based growth. And then Matt Eyring is the Chief Strategy Officer at Vivint, and he drives a lot of the strategy for the smart home business at Vivint, and he'll be talking about internal or organic growth. So we're excited to share with you some thoughts today. And as we get started, I want to just raise this question. You know, when we think about growth, we know that it's the goal of most companies, right? Companies are trying to grow in general. And as you kind of, look at the options that are available to you, you begin to think about, well, how are we going to grow? Well, clearly, one method of doing this is to hope to discover and pursue the new thing before others widely realize how good this opportunity really is. Okay, and that's how a lot of entrepreneurs I know think about growth, and a lot of companies as well. It's like, let's try to figure out what's happening in the future in a way that will help us invest ahead of others and therefore achieve some kind of, growth outcome. And I've got to tell you that as we look across the landscape, we do see this kind of growth happening. It's happening all around us. But for you and I, it turns out that this is highly unlikely. And the reason this is so is that it's just hard to be the first to discover the new thing. Sometimes you can do it, but it's not easy to do. And it's fraught with a lot of difficulty. So then sometimes people say, well, the best way to grow is to sort of hope that you're positioned in or next to a growth market as it takes off. And this is really the Dell computer story, right? So Dell had developed in the late 90s, late 80s, this direct model of sort of telephone-based ordering of computers. And they had built a whole operating apparatus around this ability to order computer by telephone. Okay, now that sounds archaic now, doesn't it? But it turned out that when the internet took off, because they had all of their operating mechanisms built up around this kind of telephone ordering, they were able to transition to the internet growth almost immediately, and they became one of the great growth stories during the 1990s. So they were serendipitously positioned for growth as the internet sort of came onto the market. Well, again, that's great for some companies, and it may happen for you, but I want to just say that it's more likely, but still not the most likely possibility. And so then that takes us to this question of, what if these options fail? That is, what if you can't discover, you don't discover the new thing, or alternatively, you're not positioned next to a growth market when it takes off, and you're just sort of sitting there with your business trying to figure out, well, how are we going to grow this? And, the answers are not super exciting in terms of the way they sound. But it turns out that what the research shows is that the way that most companies are growing, in fact, is they are taking what they have in hand. Okay, so the assets, the resources, the capabilities that they already possess, they're identifying maybe some excess capacity or some ways to leverage those resources, maybe into new opportunities, and they're leveraging those skills and resources out into these new markets and building around that. Now, part of the reason that this works so effectively is when you're holding capabilities in hand, you already know, in a sense, how they work, right? And what's more, what it does, in effect, is it lowers the cost of, say, entry into new markets because you're already holding these resources, you've already built them, investments are in the past. And so this is what we would call a high likelihood or most likely approach to growth if a company is looking for growth. The others may happen, they could happen, a blessing from heaven may be bestowed upon you and your company, but if that doesn't happen, then what you do is you look right here at home in order to find the engine of growth. So as we think about how to operationalize this particular approach to growth, then there's really two considerations that we need to think about. And these are kind of the 2 points of leverage that we can look for within the company. So the first is we look to our capabilities. Okay? Now, our capabilities are sort of, those processes, resources, assets that we already possess, the things the company knows how to do effectively. Okay, general term capabilities. But what we want to do is we want to ask ourselves, as we're considering growth options, we want to say, what percent of existing costs or capabilities are shareable with the new growth option? Okay, so that's just a general rule. So what do we have in hand? What do we already know how to do really well, such as maybe, development, or maybe we know how to, execute in India, or, we've got processes. What are they? And which of these are shareable with the new growth option that we're considering, excuse me, and how, what percent of overlap is there? And as you drill into this, you might start asking questions like, what investments have been made that are directly transferable to the new offering? Okay, and we can think about assets, people, processes. We don't want to forget people in all of this. Those, people are at the root of our capability set because they have skills that come together that are able to execute on things inside the company. So we begin to ask these questions about what is the overlap. Now, this is not going to seem terribly earth-shattering, and in fact, in the strategy field, in the research literature that we read and that we write as professors, this is a very well-known idea, this idea of leverage your capabilities, leverage your core competency. So there's nothing really new here, okay? But one of the things that the strategy literature has not done, and this is a direction that we've been going recently to begin to think harder about, is this whole notion of I'll call it the demand side of the market. This is a lot about sort of supply side, right? This is a lot about what the company sort of brings to market, from its processes or capabilities. And what we really want to do is we want to start saying, well, how do we marry that up with the demand side of the market, and what does that look like? And so we have this concept that we're beginning to introduce and to see how much traction we can get out of this idea called customer experience. And the idea here is that customers themselves have also made investments. Okay, so we've made them, but customers have made them as well. And what have customers invested in? What they've invested in is consumption of our products and other products and services in the economy. And so one of the kind of core issues of growth is, can you tap in to the investments that others have made? And in this case in particular, can you tap into investments that your customers have made? And so we start asking these kinds of questions. What percent of existing experiences and knowledge are shareable or is shareable with the new growth option? And we're talking about the customers that we might be targeting for growth. They may be our customers, but they also might be just a new customer segment that has some experience with other companies' products in some way. And as we drill into this, we can ask these questions, what investments have been made, okay, by the target customer segment that are directly transferable to the new offering. We can think about processes of searching or ordering or consuming, or my eyesight's so bad I can't even read my last dot point. The social and emotional experiencing, okay? So this idea of how, customers are learning the interface and so forth of different products. How do we tap into that? And what I want to do is then I want to take these core ideas and just array them on this framework and say, as you're thinking about growth, these are two core dimensions that ought to be a contributor to the way you think about prioritizing, okay? Prioritizing the options for investment. So if we take these two ideas that I've talked about, we take capability synergy, okay, and we think about what is the capability overlap between what we do today at a point in time and the capabilities that are required to execute on this growth option. That ranges from low to high for each option. Likewise, for the y-axis, if we sort of think about for our target customer segment in the growth option, what is the degree of overlap, low or high, okay, in terms of the customer experience that they've had in the past with other products, and is that transferable to the experience that they will have with our product or service? Then that becomes the y dimension. And so, we can start to sort of put the growth options on the chart where they belong. And what we would expect to happen is that, some of our growth options are sort of, risky in the sense that they don't have a lot of overlap with any of the, capabilities or customer experience capabilities. No overlap. Those would be the higher risk options. Now, it's not that you wouldn't want to pursue those goals, because maybe your core markets are deteriorating and you're trying to get into new markets. And so, there might be reasons that you would invest in that, but just to say those are harder because you don't already have some existing overlap. As you sort of go to the right, we get kind of the capability-driven growth. As you go to the top, we get the market-driven growth. And then what we would claim is that if you've got both things going on, that is, you've got the capability overlap sort of in the core kind of cost structure of the organization, and then you also have this customer experience overlap, then we're going to say these are the high likelihood or high profitability growth options that you might consider. Let's look at an example. So everybody is familiar with Amazon. And I'm going to talk about Amazon more in just a moment, but let's just look at a couple or three different businesses that they invested in. So one of those businesses that is by now well known is AWS, Amazon Web Services. This is the idea that Amazon, of all companies, this is sort of this idea that Amazon is selling sort of cloud space to the world is, today it seems normal, but it was a little bit of a head scratcher when it first happened. But really what they were doing in AWS is they were leveraging infrastructure that they had already built. And they had these capabilities that had already existed inside the company. And so they said to themselves, well, gosh, why don't we sell that out to the market? And AWS was then born. On the other hand, another head scratcher of Amazon was this whole Kindle episode. And at first, when they said they were coming out with this Kindle, I thought, well, wait a minute, this isn't a technology company. This company sells books, all right? How does a company acquire the capabilities to build and sell and execute on tech, from ground zero? And they can do it, but it's a harder sort of road to hoe. But if you sort of think about Kindle, it's very clearly, a growth option that taps into customer experiences. Well, which experiences? Well, they're a bookseller, and they had millions of people going to their website to order and download books. So that investment that customers had made in doing that became something that they could leverage. Now they say, well, why don't we sell them a piece of technology so that they can download those books while they're at the website onto their technology? And so they were able to leverage that experience in that case. And then, if you look at one that was a super kind of high opportunity or high likelihood growth option, it's this fulfillment by Amazon business, where they had gotten used to fulfilling orders sort of, that were coming across the web, and they said, well, wait a minute, now we can outsource our fulfillment processes. That's a capability they had built on the cost side, and they had a lot of customers out there that they could also leverage their experience with the Amazon web assets in order to invest in that market, and that became one of the most successful businesses for Amazon. So now, and I'm running out of time, and I want to make sure I give my other speakers plenty of time, but just in the last 2 or 3 minutes here, let me just share with you some follow-on implications of this way of thinking about growth options. And that is that we want to think about these options in sort of a dynamic context. We want to really understand them as sort of point-in-time investments that can leverage us into other opportunities. So let's take another view of Amazon, and let's imagine that these future Amazon businesses, future because dotted line, let's imagine that these future Amazon businesses are twinkles only in Jeff Bezos's eye at some point in time. And in fact, in 1995, these things probably wouldn't have, they weren't even, conceived of at that time. How would we position them on the growth framework before they ever came into existence? And this is the picture that we sort of think we might have been looking at that time. But then what happens is 1995 comes along, or 1999 comes along, and in fact, Amazon invests in auctions. Now that business has been shut down. But auctions turns out to be a stepping stone into the business that became Fulfillment by Amazon, because it was this platform where other sellers could come to Amazon and sell their goods, right? And gave Amazon this fulfillment opportunity, and later they transitioned that to the Fulfillment by Amazon business. Now notice how investing in auctions increased the probability or the likelihood of successful growth, right, by, for the FBA business. And likewise, if we kind of go through time here, what we see is, when they invested in fulfillment, that grew their capacity for releasing then or investing in the AWS business, because in order to deliver fulfillment, they had to build that cloud infrastructure. And so it goes, incrementally as they keep investing in these businesses, what you begin to see are these kind of transitions of each of these businesses where each investment makes the next opportunity more likely. So this is the dynamic kind of stepping stone way of thinking about this, and we have some implications over here that I'm not going to be able to read unless maybe I can pull this off of here, and I don't know how long this cord is. I've got 2 lavaliers on and a mic, so not sure, but anyway, so one takeaway is that these current period investments both leverage the past and become stepping stones to the future. And more importantly, that building a portfolio of options include both cost and customer side leveraging helped Amazon, right, to pursue a more diverse set of growth offerings. So it wasn't that they were just sort of leveraging the cost side. They were also leveraging the customer side, and that created this diversity of portfolio. And as we know, Amazon has become one of the most exciting success stories of recent years. And part of it is because of these growth pathways that they've been able to develop over time. And then lastly, just sort of thinking about this kind of dynamic process of stepping stone, by dynamically connecting these growth options, then over time what you do is you create sort of the context or the platform for a variety of very rich options to grow in the future. Okay, so let me just give some parting thoughts. So the first is, go ahead and, as you're thinking about the different options you might invest in, go ahead and map them onto the framework. And think very critically about the capability overlaps in these 2 dimensions, supply and demand side, and how that's playing out. And I think you'll get some insights, right, from doing that, from going through that process. The next one is, be sure to consider options that leverage customer investments as well. Don't only think about your own capabilities. Think about the capabilities that the customers have invested in. And that's a key takeaway for this presentation that I want to make sure that you go away with. The next is to use a look-ahead logic and think dynamically about position. Right? So the idea that whatever we invest in today is going to endow us with some capabilities for tomorrow. And in fact, this kind of raises this issue, which is that the logic of sequence suggests a possible reconsideration of ROI. You know, a lot of times we say we need businesses to stand on their own bottom, right? They need to be profitable, every one of them. Well, wait a minute, not so fast. Maybe it's the case that in fact, some losing businesses are endowing the organization with the stepping stone or the dynamic opportunity to grow in the future in some new direction. And so let's not sort of undersell that kind of an idea. And then lastly, this sequential capability overlaps create path-dependent competitive uniqueness. Okay? So because these things are dynamically connected, each one of them leveraging the resources and capabilities, the investments that have been made by company and customers, that over time, you know, you create this kind of path-dependent uniqueness that competitors cannot easily follow. All right, so that's all I'll say, and we'll invite Steve to come on up. Thank you. Or, I'm sorry? Oh, Matt, is Matt coming first? Okay. Well, I've got.
I'll go next.
Yep.
That off of you.